Good morning. I'm Guy Johnson. I'm alongside Lizzy Burton. We're an hour away from the opening trade. What do you need to know this Friday morning? President Trump defends his tariffs and dismisses the market meltdown. US and European futures point to further significant losses. Rattled investors now await US payrolls, and Powell, the Fed chair, is due to speak at 11:25 Eastern Time. And as the world figures out how to respond, we are live in Brussels and we are moments away from a conversation with Canada's Foreign Minister, Lizzy.
Well, happy Friday, everyone. It doesn't look like it's going to be a happy Friday, though, in these markets. The global sell-off continuing off the back of Donald Trump's tariff plan. And as you say, Guy, futures pointing lower on both sides of the Atlantic this morning. You already saw $2.5 trillion wiped off US stocks yesterday, the worst day since COVID. You saw the 10-year yield dropping below 4%. It's still below there now. And you saw weakness in the dollar, the worst day on record for the dollar. Euro-dollar now at a 110 handle. Can Powell and those job numbers turn this negative narrative around later? The countdown to the opening trade starts right now.
It depends. If somebody said that we're going to give you something that's so phenomenal, as long as they're giving us something that's good. For instance, with TikTok as an example, we have a situation with TikTok where China will probably say, we'll approve a deal, but will you do something on the tariff?
President Trump speaking on Air Force One, looking for a phenomenal deal. The market this morning doesn't see a particularly good deal. It is looking at further falls when it comes to equities. Yesterday was a very ugly session. Friday the 4th is going to be dominated by payrolls and by Powell. But how we start could be really significant. And it looks like European futures, as we speak, are currently lower, as are US futures. 4.5% drops don't tend to come in isolation, Lizzy, and it looks like we are going to see further pain this Friday.
Yeah, it just shows that markets are not the guardrails on Donald Trump in his second administration.
Yep.
He doesn't mind this disturbance happening, and that disturbance, as you say, absolutely widespread. Even the most bullish sell-side strategists on Wall Street lowering their calls for the S&P 500 at the end of the year. You've got to ask, would anyone be brave enough to catch this falling knife?
So what would persuade people to do that? What is the next move that we could be potentially looking for? Do we have to go back to what Donald Trump is talking about there and the possibility of a negotiation? Could that produce a big swing in the opposite direction? There's an interesting story on the terminal this morning. Hedge funds are basically sitting this one out. They can't handle the volatility at the moment that they're seeing in front of them. Could we be about to see another big swing in the opposite direction? Or if Donald Trump sticks with this, do these markets have much further to fall from here? We just don't know this Friday morning. So does Powell provide some sort of guidance for the market today? Do payrolls give us some sort of clue as to where the Fed is going to be going as well? That's, I think, the next big point that we're going to be watching out for.
It's so crucial, the language that Powell uses when he speaks later on today. Does he drop the word transitory into his language again?
Or does he drop it from the language?
Exactly. Does he cut it out? Because if he then instead uses the words two-sided risks, the dual mandate, then you could see markets going into a tailspin for the weekend.
Absolutely. And how much risk do you want to carry into this weekend is another key question, as you say. We've got a whole load of market factors that are coming together today. You've got oil prices that we want to talk about. You've got what is happening in the foreign exchange story. The dollar is not doing what you would have expected. So much going on. And everybody around the world is trying to understand what they do next. We're going to be hearing from the Canadian Foreign Minister in just a moment. The EU is trying to work out what it is going to do. The Brits are trying to figure it out. The world is trying to understand what a phenomenal deal looks like. And can we really negotiate? Because Trump's saying yes, Bessent's saying no.
Well, Bessent said that this is a cap. This is as bad as it gets. Just don't retaliate. But then you've got the EU and China saying we very much do plan to retaliate here, even if the UK does not, and it wants to be a bit more productive here when it comes to a solution. On the other hand, you've got the likes of Canada as well saying that they want to stand up to Donald Trump when it comes to tariff. Mark Carney fired up by this.
Well, the thing is, though, he's got an election coming, and I think you also need to fold the election calendar into all of this as well. Think about what Macron is doing right now. He has a political problem at the moment that is fairly significant, as a result of which he's fired up on this as well. Carney's fired up because basically he's got an election to fight. he needs to be looking tough for the Canadian people in his response to Donald Trump. The Germans maybe are in a slightly different position. They've just fought an election. Are they in a position now where they feel that they can take a more pragmatic approach to what is happening here, and maybe not pulling politics into it? The Chinese look like they're going to be responding as well. If one country responds, do others feel that they have to respond too? We're going to get two different strategies: respond, don't respond. I don't know, and that's the problem for markets. We don't know. Is there a further round of escalation that could be coming here?
Yeah, you joked that, that earlier in the week it was going to be Clarity Day. It is the absolute opposite of Clarity Day.
There was some irony involved.
I sense that, Guy. But, this is just pure uncertainty on what the retaliation looks like, what the negotiation looks like, and then does this lead to a recession in the US? Does it lead to a recession in the global economy because businesses are holding back on that investment? And indeed, Macron saying deliberately you must hold back on that investment because it would stand against collective solidarity.
That's really difficult for companies. They're looking at the situation saying the US is a massive market. I have to invest in it. I have to put capital to work there. As a result of which, yes, they're going to listen to Macron, but it's going to be really hard to resist that temptation, maybe to up the ante when it comes to US investment. But all of this is so uncertain right now. Everybody's just basically sitting on their hands, waiting to see what's going to happen, and that's also bad news.
Uncertainty, the word that markets absolutely hate. But as you say, Canada escaping President Donald Trump's latest round of tariffs, but Ottawa taking a firm stance against other levies that Washington has already imposed on the country's goods. For more, let's go to Bloomberg's Oliver Crook, who joined us from the NATO Foreign Ministers meeting over in Brussels with a very special guest. Ollie.
Yeah, Lizzie, thank you so much. Yeah, NATO is really, the topic here is supposed to be defense, but of course sort of tariffs have eclipsed the conversation, I think, almost everywhere in the world. So we're very pleased to be joined by the Canadian Foreign Minister, Mélanie Joly. Thank you so much for joining us today.
Thank you, it's a pleasure.
So listen, I'd like to just begin on the tariff conversation before we get into defense. You've been at it for a long while. You were spared from the sort of tariff unveil yesterday. However, you have now retaliated. I'd like to just talk to you about your approach and how to deal with Donald Trump and these tariffs.
Well, let's be very honest. Let's be clear. Tariffs are taxes on Americans. So I think this will affect their wallets. This will affect their capacity of having access to great opportunities and better lives for their kids. Why? Because fundamentally, when you look at it, when the U.S. imposes tariffs on countries, well, of course, we retaliate like we did. At this point, we're more than $60 billion worth of retaliation on American goods. And we know that Canada is the biggest client of the U.S. We buy more from the U.S. and from American businesses, and particularly small and medium-sized businesses, than France, the U.K., China, and Japan combined. So in that sense, this will hurt Americans. So that's why we launched an ad campaign across the U.S., particularly in red states, saying that tariffs are a tax on hardworking Americans.
And what has your contact been now with the Trump administration? I know it's been enduring for many, many months, but since the sort of reveal of these tariffs, are you making any progress? Are the negotiations live right now?
Well, we're right now in an electoral campaign back home, so the Prime Minister and the President agreed that they would be talking after the election. But what I can tell you is I had some constructive discussions with the Secretary of State. We have a very productive working relationship, Marco Rubio and I. We speak to each other often, and we agreed that on things we disagree, we can even still continue to talk. Because our strategy is clear. We're putting maximum pressure on the Trump administration to pull back on any form of tariffs. We are, at this point, under many tariffs, some on steel and aluminum, on auto, and on part of our economy as well. And at the same time, my job as the head of diplomacy in Canada is to make sure ultimately that we find off-ramps.
Yeah, but I think the sort of at the fundamental base of the philosophy behind what the Trump administration is doing is this idea that the United States has been aggrieved in a major way on the international stage on the question of trade. And so that being said, there's also all this talk that they're talking about basically non-tariff barriers. So is it clear to you, do you have an understanding of how you sort of can have an exchange rate, so-called, between a tariff rate that the U.S. has imposed and these non-sort of tariff barriers that they're trying to change? Do you have a clear idea of what they want and how to approach that kind of negotiation?
No, I think the only strategy the U.S. is putting on the table right now is they want to have strong hands every time they're negotiating with countries, and they want to do bilateral deals. What is clear is the president wants to do a global reset on trade, and it's his vision to do so. I've had conversations with Secretary Rubio about that, and the question is how much political capital is President Trump willing to spend on a recession? Because we know that this will hurt the economy. We saw markets tanking yesterday, and we know that all this trade uncertainty is going to ultimately affect just consumer habits and at the same time the investment climate. So we know back in Canada that we have to invest in ourselves. We have to do more amongst our provinces and territories to make sure that there's no barriers to trade amongst us. That's the first thing. Second, we're looking to the European Union to be closer, and we're looking to partners in Asia also to be the case.
And this is my next question, because given that the Trump administration basically seems to be betting on the concept that they're the only game in town and that they will be able to get their way on all these things, this is what we've heard from the cabinet, this is what we've heard from Donald Trump. Does this sort of change your concept of how the relationship with the EU needs to be, and even the G7? Do we need to start thinking, from your perspective, of a G7 -1?
Well, so a couple of things on that. First, we know that the relationship with the U.S. Has fundamentally changed, and we take stock of that. We're the biggest, the best friend of the U.S., the best neighbor, the best partner, and we want to make sure that at the end of the day, we get to an agreement on trade, but also on security. So this will be the end game. When it comes to other partners, Canada is the most European, non-European on the planet. We've always been close to Europe. That's just part of our DNA, our history. Even the head of our state is a king in England. So our goal is to be closer to the UK, but particularly the EU. We have a free trade agreement with the EU. We want to be part of the Rearm Europe defense procurement strategy that the EU is working on. And we believe that we can offer many things to Europe and vice versa.
Are there formal steps being taken in that direction?
Yeah.
New agreements kind of getting into these programs?
Yeah, so there is a white paper that has been published by the EU on defense procurement, and we've had numerous conversations and input into that paper.
And on that question of defense, when we think about kind of the willingness of this American administration to exert influence on allies, we think about how much of everybody's defense hardware comes from the United States, how dependent that hardware is on software updates in the United States. Does it concern you to think about the administration potentially exerting pressure in that way? And would it incline you then to start thinking about sourcing some of that hardware elsewhere, particularly the EU, which is now trying to build out its industrial defense base?
Well, so we want to build our own industrial defense base. We know that we have everything when it comes to natural resources, from uranium to also energy. We know we have the best AI researchers in the world. We know we have lots of SMEs in the AI sector. We know also that we have an aerospace sector, an auto sector that ultimately leads us to have strong manufacturing capacities. So we have to create more jobs at home in investing in defense. We're over-reliant on the US, we know that, and we have the same how can I say, understanding as Europeans of the necessity to become a bit more independent when it comes to defense. Now, at the same time, we know that the industrial capacity of the U.S. when it comes to defense is really difficult to change overnight. So we'll continue to find ways to work together, albeit all these difficult times these days, but at the same time, we know we have to pivot, and that's what we'll be doing.
And I think that many of the people listening to Marco Rubio yesterday within Europe, within NATO, were very reassured by the message that the Secretary of State had, which was basically a full-throated commitment to NATO, but a NATO that is spending more on its own defense and taking it more seriously. He reiterated once again that 5% target on defense spend. He, in fact, suggested that the U.S., for the first time, will spend 5% of their GDP on defense. Is that a figure that is realistic for Canada to achieve, and on what timeline?
So the U.S. is at 3.2 at this point, so they're still very far for 5%. We also know that the ultimate and only decision maker in the American system is the president himself. So we look forward to be constructive for the next NATO summit, which is coming in The Hague. We need to make sure that that summit is a success. Canada will be meeting its defense spending targets. Canada will also invest, as I said, more in creating jobs at home in the sector. And we know that, yes, we have to invest more in NATO, but fundamentally in Canada, we need to invest more in us, in our own continental security, in our own Arctic. And also we've been saying, and I've been saying at the table of NATO now for 3.5 years, we need to concentrate on what's going on in the Indo-Pacific and in China, with China's involvement across the Indo-Pacific. That's really, really important. And many of our European friends see Russia as a threat. We see Russia as a threat as well. At the same time, Russia is working with China in the Arctic, so we have to take stock of that. And also China is extremely, its behavior is extremely preoccupying in the Indo-Pacific, and Europeans need to take stock of that.
And you've just spent 24 hours basically with the Secretary of State, Marco Rubio, here in Brussels. Can you just give us a picture of what those conversations contained and what you took away from them?
So when speaking with Secretary Rubio, we talk about just our political reality at home. Both of us. We talk about tariffs, of course, and what are the next steps regarding tariffs. We talk about just overall security, and we talk about the fact that we need to get to a good deal on Ukraine, on the Middle East. We talk a lot about our own hemisphere also, Haiti and Venezuela, for example.
Well, thank you so much for your time today, Melanie
Thank you.
Joly, the Canadian Foreign Minister there, addressing everything from, of course, tariffs, which has basically eclipsed every conversation, I think, for the last 48 or so hours, but, of course, European defense and the future of NATO.
All right, Bloomberg's Oliver Crook, we thank you for a fascinating conversation on day 2 of that foreign ministers meeting at NATO in Brussels. Guy, so much to talk about in that conversation, not least on the tariffs front. Joly there saying that Canada's going to put maximum pressure on Donald Trump, that Canada's looking for support, particularly from Europe, particularly from the EU as well as the UK, but also looking to China for support. And then those comments on NATO as well. You know, Marco Rubio, the Secretary of State in the US, saying that everyone else should be spending 5% of GDP on defence. But Joly there pointing out even the US isn't doing that yet.
So very clear that she wants to partner with others, which I think is interesting, which is a big problem potentially for Washington if others come together. They've said don't do that. If you do that, there will be consequences. That's been the line from Washington thus far. She made it very clear at the beginning of the conversation. They are in an election fight right now. That is a process that is unfolding in Canada. The conversation with Trump, therefore, comes afterwards. So, therefore, we're going to get a conversation that is maybe a few weeks down the road. But in the meantime, do we see a response from Canada because it makes Carney look strong? And I just wonder whether that is something, a lever that Carney will ultimately pull. But a Canada and a Europe together, I think, would be an interesting combination, and would be interesting to watch what Trump would do with that.
The most European, non-European country, says Joly. Indeed, the fight against Donald Trump is the ace in Carney's pocket, it would seem, given that, you know, for so long his party were written off at this upcoming election. So we'll see how far Canada is willing to take that retaliation. But coming up on the programme, we're going to keep an eye out on the European market open, with equity markets projected to continue falling, while also up next, the world weighs the potential tariff responses, and we're going to discuss the view over the policy options on the continent next. If you've got any questions of your own for our guests, please do send them in to us on IB plus BBTV Go. Stay with us. This is Bloomberg.
Friday the 4th, good morning. We are 36 minutes away from the equity market cash open here in Europe. Futures are negative. They are firming a little bit stateside. They're well off their earlier lows, which were hit at around 6 a.m. UK time this morning. So we're off the lows. But it's a struggle by the looks of things, and certainly we're not popping back into positive territory right now. Bond markets are about to open. Equities are about to open. We're watching the foreign exchange story like a hawk this morning. There's plenty going on around the world, Lizzy.
There is. Let's get you updated on what else you need to know to start your Friday morning. A South Korean court has removed President Yoon Suk-yeol from office over his martial law declaration. The move paves the way for a presidential election within the next 60 days, which Yoon will be barred from contesting. The court's decision marks a potential conclusion to one of the most turbulent political chapters in the country's recent history. Elsewhere, Bloomberg has learned that Republicans are weighing the creation of a new bracket for those earning $1 million or more to offset some of the costs of their tax bill. The move would be a stark departure from decades of GOP opposition to tax increases. Sources tell us they're negotiating a new top rate that would be around 39 to 40%, bringing the rate back to where it was under President Obama. And France and Germany are pushing for a more aggressive response to President Trump's tariff measures, advocating for a forceful retaliation that could strengthen the EU's negotiating position. The bloc is considering options including a digital services tax on US companies, retaliatory tariffs, and deploying the group's anti-coercion instrument. The Commission is also working on a term sheet of possible concessions that it could make to the US to help reach a settlement to remove or reduce the duties. So that ACI, the anti-coercion instrument on the table, Guy, that's kind of the nuclear option here when it comes to what the EU could do.
The French want to put it on the table, but I think it's going to be a difficult negotiation within Europe to figure out exactly what the response ultimately is going to look like. And whether or not services get dragged into the conversation as well, I think is a really difficult part for Europe to deal with. That would obviously spark a fairly significant response stateside. So, yeah, I think it's going to take time. But we've got a meeting coming up Monday. I think we'll get some shape maybe at that meeting as to where Europe wants to go with this. How do you respond? Should you respond? Should you take Scott Bessent's advice? The problem is that these are politicians. They have electorates back home that they need to think about, and how it goes down, simply rolling over. Is that politically possible in the current reasonably febrile state of European politics?
It's interesting as well if you contrast the UK response potentially to the European response here, because obviously the UK got a 10% tariff compared to the 20% that's on the EU. That's the minimum. Yep. The question is, can the UK negotiate anything other than that? What's the point of talking to Washington if you can't negotiate anything other than that? And then when you feed that into the central bank story, you know, it's a clearer sense of what happens to the BOE than it does for the Fed.
OK, so bonds are currently lower. We've seen German bonds opening. US Treasuries are also lower this morning in terms of their yields, i.e. bonds are catching a bid this morning. We are going to be hearing a little bit later on from Jay Powell. Clearly, we've got payrolls coming up as well. But what we need to talk about next, the message from 1600 Pennsylvania Avenue is that after the market's meltdown, a boom will ultimately come. We're going to dig into the tariff fallout and work out where we go next. This is Bloomberg.
I think it's going very well. The markets are going to boom, the stock is going to boom, the country is going to boom, and the rest of the world wants to see, is there any way they can make a deal? They've taken advantage of us for many, many years. For many years, we've been at the wrong side of the ball, and I'll tell you what, I think it's going to be unbelievable.
President Trump about to board Marine One, speaking about the markets, talking about his view that ultimately we will see a boom. Not this morning, though.
Yeah.
European and US futures are in negative territory. Investors are bracing for more pain. Wall Street suffering its worst day yesterday in 5 years. Let's talk about the setup, therefore, for Friday morning. Valerie has more details.
Hi, good morning. I was taking a look at the comparable drops this century versus what happened yesterday, and the comparisons are pretty eye-opening. You know, a 4.8 drop yesterday in the S&P 500 lines up quite easily with the worst that we saw of the dot-com bubble. That was a drop of nearly 6%. The worst of the September 11th attacks, that was a drop of 4.9. The GFC saw worse drops, worse one-day drops. So did the U.S. downgrade back in 2011, and the worst of the COVID drop of 12%. But yesterday was a historic day for the S&P 500. Its worst day in 5 years. And under the hood, there were some sectors that entered a bear market. One of them being the Mag 7. It's now down nearly 25% since its peak in December. Small caps in the Russell 2000, that index also entered a bear market, now down 21% since its February highs. A lot of that being hurt by these growth fears around the U.S. economy. Bank stocks really underperformed with this credit widening spread yesterday. And lastly, Guy, I want to talk about the dollar. The dollar really underperforming yesterday. At one time, the Bloomberg Dollar Index sliding over 2%. We've now wiped out all of the post-election gains for the U.S. dollar, and we're starting to question when is the dollar smile going to kick in? The dollar normally outperforms in times of massive global risk aversion. It's yet to really do that, and it's starting to question on whether this dollar smile theory is something for the history books and maybe not practical to what's going on today with these assets leaving the U.S. economy.
Turn that smile upside down. Valerie, thank you very much indeed. Valerie Titel joining us on what is happening in markets, finishing up with what is happening with the buck. When does the buck stop on the downside? I think is a key question right now. The weakness we've seen in the dollar, significant. Let's talk about where we go from here after the sharpest intraday decline in data going back to 2005. Ollie Brennan, FX volatility strategist at BNP Paribas Markets 360, joining us around the table this morning. Is it logical to sell the dollar right now? Is that the right trade, and does it carry on?
Morning, guys. Thanks for having me. Is it logical to outright sell the dollar, or is it logical to rotate out of US assets because you're worried about there's going to be a recession? And I think that's the dynamic that's taking place. There's been a decade-long build-up in foreign ownership of US assets. The size of the tariffs announced were a surprise to us. They were a surprise to the rest of the market. And they increased the questions about the nature of the US economy going forward. They increased inflationary risk.
So we're in a situation, and also it raises questions about, as you say, capital flows and the deficits. If you have a smaller deficit, if the trade deficit changes in any meaningful way, presumably capital flows change on the back of that, and that is maybe just what we're seeing.
Yes, I mean, the trade deficit doesn't change the day after tariffs have been hit, so this could be a very long, drawn-out process. But for sure, there's certainly expectation that the intention of the reciprocal tariffs appears to be to close bilateral trade deficits rather than to adjust them. And if that happens, then the US trade deficit in aggregate has to shrink, which means capital inflows have to shrink, which absolutely would change the shape of the dollar smile.
So, Ollie, is there anything that Chair Powell can say today, or what should he say to try and turn this around before the weekend?
Yeah, it's a really difficult balancing act because on the one hand, you've got the market expectations or the market fears of stagnation in growth. But on the other hand, you've got the risk of very high inflation. On a conservative estimate, the level of tariffs will push our measures, our expectations of inflation above 2%, above the target rate. You've already got extremely high long-term inflation expectations in the Michigan surveys and the New York Fed surveys. So it's certainly not a case that the Fed can just turn around and ease policy directly. They have to balance out these two drivers. So in a way, Powell has to toe the line, has to kind of maintain a stable outlook.
And flipping to another central bank, the ECB, it was interesting yesterday to look at, the euro strengthening, but actually bets on ECB cuts ramping up at the same time. So clearly currency traders not having the same faith, perhaps, in that story. I don't know if that's how you interpret it. What do you see in that? Yeah,
there's similarities here between the last time euro had a very powerful rally, between the last time Trump was president from 2017. And that was a period when euro-dollar rallied despite ECB rate cuts, despite the rate differentials going in the opposite direction, largely because it was a growth dynamic change. And that may be what we're seeing here. The market's re-rating US growth down But Europe has a fiscal stimulus cushion. So in comparison, the downgrade to European growth is smaller, and therefore you have this growth dynamic change, which is net bullish the euro.
How high does the euro go?
Our year-end forecast is 112. We nearly reached that.
I was about to say.
But we think what we're seeing is the beginning of a long-term rotation in asset allocation.
So north of 112, I guess, is really what the question I'm asking. Your
our
expectation would be that you
forecast
would push the forecast higher at some point.
If we start to see the asset allocation rotation as we expect, it would open up more upside, yes.
Where do I hide in all of this? I note this morning that the Swiss franc is at a record against the Aussie dollar. They seem at polar ends of the spectrum. Talk to me about what you think the safe haven story looks like.
Well, yeah, that's an interesting point, because maybe euro is a safe haven as well. So typically your safe havens are Swiss franc, Japanese yen.
What about the pound?
The pound is...
He pauses for a moment.
A pregnant pause, Ollie.
The reason safe havens work is because they're typically the currencies in which portfolio investors return to, having invested in high beta assets originally. So the Japanese yen has reallocation flows, the Swiss franc and so on. That's why the euro may be a safe haven this time, because there is the reallocation. Sterling doesn't really have that support. So although the UK has been relatively shielded from the high tariffs, it may not be shielded from a global risk slowdown.
I was kind of wondering about the pain point for euro and sterling when it comes to making your exports more expensive, because that currency strength is surely kind of doing the tariffs work for them, right? Surely there's a point at which that incentivises those governments to retaliate. I know that the EU's talking about that already, but the UK is certainly not. The UK tone is still very pragmatic.
Yeah, I suppose from the UK's perspective, the UK typically exports higher value-added goods. So the cost of tariffs is not a commoditised export market like maybe China or Southeast Asia. And in Europe, that's probably why we're seeing interest rate cut expectations increase. The ECB probably doesn't want the combination of a stronger currency to create a disinflationary trend at the same time as weakening exports. So this creates problems for all central banks. You've got inflation creating a growth slowdown rather than a growth slowdown and inflation moving at the same time.
If Powell's late, if the inflation narrative is a concern, just fold that into the FX story as well. If he decides that actually there is an inflation risk, this is not something he can look through, how does that factor into the dollar trade?
So it would be stagflationary for the dollar. So we think that would still be a portfolio reallocation trade. And this is really the elephant in the room for the US. European investors, Japanese investors, global investors have been invested in the US outperformance story for so long that if the US outperformance story stumbles, then we can get that reallocation out, and then we would see a trend weakening in the dollar.
Interesting, just mentioning the BOE. You've actually just seen traders adding to their BOE cut bets as they open, so now fully pricing in 3 more cuts from the Bank of England this year. But let me ask you, Ollie, we've seen this elevated volatility, not just in the bond space, equities, FX as well. Are we in this new regime of higher volatility, or is this kind of a knee-jerk reaction to just how much of a worst-case scenario that tariff package was?
Yes. I'm an FX volatility strategist, so I'll say we're in a new regime for volatility. But we really saw that immediately after the election. Trade policy uncertainty has gone up very quickly, and it's remained very high. And really, FX is the balancing item. If nothing else changes, FX moves to offset trade costs. So if trade uncertainty is high, exporters and traders' uncertainty about where they're hedging goes up. So they need to use options.
So what are real money accounts doing right now? If I'm a corporate, if I'm trying to work out how I balance my books, what are the questions they're asking? What are you hearing as your clients come to you at Paribas and ask those questions?
I mean, is it a good time to use options to hedge? And that's really the bottom line. Option volatility, the price of options has gone up since the middle of last year.
So corporates are hedging more, are they?
Corporates are using... Yeah, there's more preference to hedge using options than there was 6 months ago, for sure.
OK, that's interesting. Be interesting to see how that shows up in the corporate numbers we're about to get. Are we going to get guidance? You think about what's going to happen in terms of the reporting season. Companies are really going to struggle with guidance. FX is going to be a huge part of that narrative. If they can take some of that out via the options market, maybe they have a little bit more visibility on what their business is looking like, but I don't know. It's going to be a hard battle.
Good
Anyway.
time to be in the volatility business. Ollie Brennan, FX volatility strategist over at BNP Paribas Markets 360. We thank you. Good to have you around the table. Coming up on the programme, we're going to take a closer look at the stocks to watch at the open, including BP. The company announcing this morning that the chairman, Helge Lund, plans to step down following turbulent times at the oil major. That's next. This is Bloomberg. Just over 15 minutes away from the opening trade here in London, and you're looking at futures pointing lower on both sides of the Atlantic. Looking specifically to Europe, and Euro Stoxx 50 futures are down 0.4%. It's pretty much bleak across the picture, but the CAC 40 also looking to suffer a bit less of a bad picture, shall we say, when it comes to London futures. But the sell-off continuing off the back of Donald Trump's tariff package, it appears.
Is the market expecting Europe to respond? I think is one of the key questions that we've now got to work out. What do we price in terms of that response? What will be the response to that response? And I think this debate, and we're pivoting towards a big conversation that's going to happen at the beginning of next week as European leaders come together to try and thrash out that response. If it turns out to be more aggressive, then we get into another spiral. And I wonder whether or not that's the next leg that the markets are going to take. If they take a more conciliatory approach, then I think you could get a kind of big move in the opposite direction. Bonds are bid this morning. The dollar is still down. Yesterday, obviously, was quite the session. Where do we go from here? What clues are our markets looking for? Simon White, Bloomberg Markets live macro strategist, joining us now. Simon, the Friday session, what are you expecting?
Well, we're already seeing futures today. They are sort of taking a little of a pause a little bit, but we have some data later out today that could be fairly important. So we'll see what happens with that. But I think it's, there's a lot to digest here, and it'll take a little bit of time before the markets can fully kind of take all this in. But I think what's interesting is that although the sell-off yesterday was quite sharp, and a lot of it happened at the open, there's still not signs of the kind of outright panic that you tend to get at tradable bottoms. So there's sort of signs of capitulation. So even after yesterday's close, you could see many of the breadth measures like advanced decline, number of stocks making new lows. Now, they've picked up, but they're still not at the same sort of extreme levels that you would see normally that provokes a lot of buying and therefore some sort of tradable bottom.
Well, yes, Simon, this has got to be the most optimistic headline I've read all morning. A panic is not necessarily a bad thing for the stock market. One of yours, I believe. Why? Why isn't it so bad?
Well, that's exactly it. I mean, if you want to clear the decks and lay the ground for recovery, markets tend to have a capitulation. They have a sort of panic. And the interesting thing about this correction is there's really been a kind of absence of that most of the way down. Yesterday, to say, was the closest we saw. But interestingly, yesterday, we had we're down almost 5%, 4.8% a day. And the VIX basically closes at 30. And it's never happened before. The VIX has always been higher when you've had a decline of that size. So, you're really not seeing the same sort of signs of outright capitulation that you've seen, say, in 2022. And perhaps we need to see a little bit of that before there's a chance of the market recovering. So we'll get more of that today, like whether we get another decline to K, whether we see more of that kind of capitulatory selling that's extreme enough such that you really clear the decks and the market can show some signs of recovery.
Simon, is Jay Powell a participant in this process or an observer of this process? Does he need to wait for more information before he can actually make a call on what the Fed should do next? Or does he need to step in and start to give the Fed an active role in what is happening?
I think we're all participants in this process, along with Jay Powell. It's a hugely complex thing. You're almost, it's like you're back in the pandemic, right? You're taking a very highly complex system and you're kind of like trying to turn it off or turn it down. And that's kind of what the US has done. I mean, interesting enough, though, I think it's worth keeping an eye on a bipartisan bill that, if it gets passed, we'll see if it's got enough support that would require tariffs to be passed by Congress. So, none of this is necessarily set in stone. And we also have the possibility, of course, of deal making. behind closed doors. I'm sure there's a lot of frantic deal making going on. The US has made noises that they're not interested in this, but on the other hand, we know that Trump as a deal maker is going to be looking at ways to maybe make a deal with other countries.
Simon, let me throw in you a bonus question. Settle something for us. Is the dollar smile theory over?
Yeah, I mean, I think this big fundamental changes here, quite possibly. I think the dollar is actually very interesting as well. I think it is the kind of like the pinch point. So we're now, as you guys were saying earlier, it's reversed almost all of the post-Trump rally. But what a weaker dollar does is it amplifies the effect of tariffs on US consumers. So if the dollar keeps selling off, at some point, it's really going to be a bit of a problem politically, I would say, in the US. So I think that's kind of interesting. Say the dollar sells off another 5-10%, that might be a sort of convenient out, because then the Trump administration can say, well, look, the euro's up here, the yuan's up here, other currencies are stronger. You know what? We've got kind of some of what we want, and they can sort of soften their rhetoric and soften their approach. So I think the dollar is the kind of the single thing that you can keep an eye on to sort of, so what's the tolerance in the US for this tariff policy?
In terms of, therefore, what we think about for the Fed going forward, the inflation dynamic around the dollar is going to be interesting. The import factor that it plays, the import role that it plays is fascinating. The market's now pricing in 100 bips of cuts from the Fed this year alone, Simon, yet inflation looks like it's going to tick higher. Can both of those two things be right at the same time?
Yeah, because they operate, I guess, over different timelines. I mean, if the Fed is willing to look through tariffs and inflation because they're like, look, maybe this is going to be a one-off thing, they're going to be more focused on growth, and these cuts are the cuts that are priced in are logical. But it's not going to take away the kind of like the lingering effect that inflation is having, right? I think the market's now got used to the fact that inflation isn't going to go away. So that's really going to make life a bit more difficult. So I think it's logical to have those cuts priced in. I mean, the market is kind of saying, look, the Fed is going to prioritise growth. But it's really going to make the actual outcome a lot more complicated because you're going to have this spectre of inflation that probably is going to limit how much the Fed can actually end up cutting.
All right, Simon White, Bloomberg Markets Live macro strategist, we thank you. And remember, you can get up-to-date analysis and insight from Simon and the rest of the team. Just go to MLIV Go on your terminal. Let's go from the macro to the micro, and Joe Easton has our stocks to watch. Joe.
Morning, Lizzy. So I'm watching the pharmaceutical sector today in Europe after Trump suggested last night that there could be tariffs coming onto the sector. Trump saying on board Air Force One that the pharma sector is going to see these tariffs come in, he thinks, at a level that we haven't really seen before. And we did see some declines in Asia peers, particularly in India. There were losses in some shares there. And remember, this is coming off the back of a day where the pharma sector outperformed, avoiding the heavy losses that we saw in the European market. We can see Astra, Glaxo, Novartis, Genmab, all of them had decent gains or decent performances relative to the drop in the broader market yesterday. So keep an eye on that sector. Then we're also watching BP on the news, breaking a few moments ago that the chairman is standing down. Now, this coming amid continued activist pressure from Elliott, which wants the firm to speed up its transition back towards traditional energy and away from renewables. We can see that stock has really underperformed the old rival Shell over the past few years. We can see Shell doubling on a 5-year basis, BP pretty much unchanged, so keep an eye on that one. Then in terms of M&A, Gerresheimer, we're getting news that KKR potentially walking away from the bid for that firm. Remember, they made the injectables that Novo Nordisk uses for its obesity drugs, has had a bit of a slump over the past year, so did attract that M&A attention, but this is going to be a negative potentially for this stock, though potentially some of that might have been priced in over the past few days, judging by that chart. Then in terms of analyst ratings, a couple of big ones in staple goods. Nestle underweight at Morgan Stanley, but they upgrade Danone, switching their preferences on the big European staple goods. And then Leonardo in defence after a huge rally, of course, downgraded at Citi, potentially could be a little bit softer in Milan this morning.
OK, Joe Easton, our equities reporter, we thank you for those stocks to watch as we inch towards the open. Looks like it's going to be another grim session. Euro Stoxx 50 futures down nearly 0.6%. A bit of a better performance, it looks like we can expect on the FTSE. Perhaps that aligns with the fact that the UK has been slapped with lower tariffs than the rest of the EU, that the EU looks like it's going to retaliate in response to these tariffs, whereas the UK seems to be looking more for a conciliatory approach. Don't know how far that will get them. We'll discuss that later in the programme. But the CAC 40 futures also down 0.5% as Macron really coming out hard in terms of what he wants the EU to do in response to Donald Trump. Coming up on the programme, we will take you all the way to the market open as we look at these futures very much in the red, Guy.
Absolutely. In terms of other things that are happening, keep an eye on what is happening with the bond market and what is going on with the dollar. The Bloomberg Dollar Index absolutely flat right now. So we'll wait and see what the next move is. I suspect we're sitting waiting for Powell and payrolls, both of those two key events coming up out of the United States a little bit later on. At the moment, the bond market is catching a bid. We're led by the United States. It is down by 6 basis points at the 10-year tenor. Europe down by, well, Germany's down by around 5 basis points this morning. Front end of the curve, pretty similar in terms of the response we're seeing there. European markets are about to open this Friday. Could be a bumpy ride again. That's next. This is Bloomberg. Friday morning, good morning. I hope you're all fully caffeinated. It looks like it's going to be another bumpy ride. I suspect that a lot of PMs out there probably didn't get a lot of sleep last night. Probably not a lot of sleep the night before either, as a result of what we're seeing in these markets. Yesterday was epic. Today feels a little bit more muted, but nevertheless, we are still expecting losses when it comes to European equities. We'll get to the futures in just a moment. Quick history lesson. Europe goes down pretty much left to right yesterday. As you can see, that's the white line. Choppier session in the United States, but still we sell off into the close. That's not a particularly good sign from a positioning point of view, and takes us into what we are seeing this morning. So let's talk about the futures position and what we're watching here in Europe and over in the United States. Bonds are catching a bid, equities are on offer. That's the trade we're watching, and it continues this morning. Euro Stoxx 50 down by 0.6%, DAX futures down by 0.4%. It is a similar story over in the United States. Remember all those years when you just bought the dip? This doesn't feel like a dip, as we were talking about a little earlier before the show. This is a drop, not a dip. Do you treat the two differently? And I'm wondering, therefore, if we do get some sort of response today. We're waiting for Powell. We're waiting for payrolls. They've still to come, Lizzy. There's a few single stocks that are worth watching out there this morning, but this feels like a top-down, not a bottom-up market.
Well, Trump's hanging over some of these single stocks, Guy. I'm looking at European pharma, flagged to us by Joe Easton there, after Donald Trump said that pharma tariffs are going to come at a level not seen before. So keep an eye on the likes of Astra, GSK, Novartis, Novo Nordisk. Also keep an eye on BP, the chairman standing down after activist pressure from Elliott, and Gerresheimer on the news that KKR might be considering dropping out of that takeover bid. But let's get ourselves to the open, Guy.
OK, time for the market open, time for Friday morning session. Let's take a look at what we are seeing here. We're expecting a negative start to this Friday session. Payrolls are coming, Powell's coming. Let's talk about the here and now. FTSE 100 probably getting away with it a little more than most this morning. Let's see how BP trades in that session. But the IBEX is down by 0.9%. The losses continue in Spain this morning. You've got the Stoxx 600 down by 0.6%. We're expecting a negative response over in Paris as well. Maybe 0.4%, the loss that is anticipated at the get-go this morning. We're expecting that in a few minutes' time. The DAX we're expecting to drop as well. There you go. The CAC down a little bit more than that, maybe. We're down by 0.7%. We're expecting losses on the DAX. We're waiting for losses on the SMI. We'll probably have to wait for those losses. They come in a couple of minutes' time. Lizzy, walk me through the sectors, walk me through the stocks.
So at the moment, you've got all but two sectors in negative territory this morning. Food, beverages and tobacco, and consumer products and services actually managing to eke out gains. You've got food, beverages and tobacco up 0.2%, but everything else is in the red, Guy. Banks at the bottom of the basket down 2.4%, followed behind basic resources. That's down 2.4% as well. Energy down 1.6%. And if we look over to BP, down 0.5% this morning. morning on that news that the chairman is standing down. We had all of that activist pressure from Elliott, and indeed the push has come to shove. We've flagged the pharma sector as one to watch as well. A lot of names in the red here. So Astra down 1.7%, as is Novartis. Novo Nordisk down just over 1%. GSK down 0.8%. Misery there on this prospect of more pharma tariffs from Donald Trump.
So what is interesting is defence stocks are doing well. There's been plenty of commentary, some of it coming out of Finland overnight, talking about defence spending. You have the NATO ministers' meeting, which is taking place today. Defence catches a bid on the back of that. Rheinmetall is up 2%. You've got BAE Systems trading higher as well. What is interesting as well is I see in the mix that we do see some luxury stocks actually doing relatively well. LVMH is doing some heavy lifting on the upside. The breadth, though, is pretty negative. You've got 118 stocks to the upside. You've got 450 down in the Stoxx 600. And as you say, the pharma sector very much under pressure. Astra, Novo, Roche, Novartis, all giving back ground this morning. Oil stocks generally are under pressure. Unsurprising, given the drop we've seen in crude. We've seen a big surprise coming out of OPEC, OPEC Plus. The fact that they are pumping much more crude, shocking the market. Maybe some political pressure coming through from the White House there on that front too.
Yeah, an absolutely stunning policy reversal from OPEC Plus on that. Have to factor in the tariff story, of course, as well when it comes to demand. But oil dropping yesterday to Brent now at $69 a barrel, WTI at $65 a barrel. So as you say, that feeding into the stock story this morning as well. Let's get some analysis on how this market is opening. We've got Wolf von Rotberg, equity strategist over at J. Safra Sarasan. Thank you so much for being with us, Wolf, on another bleak day, it would appear, for these markets. I want to be a bit more optimistic, though. Let me paint you a picture. Let's say that this is as bad as the tariffs get. That's what Scott Bessent tells us we should accept. This is just a cap. And from here on out, no one's going to retaliate. It's just going to be negotiations. Do you therefore buy US equities at this point and hope that confidence is back by the end of the year?
Well, I'm not at this point yet, to be honest. I think the market has not yet fully priced the economic fallout from the tariffs where they're sitting right now. I don't think that we get any, or maybe minor at best immediate negotiation results, but not any major reversals here. And I think there are a couple of reasons for that. Number one being, Trump has provided a calculation on the tariffs which doesn't really provide any, anything the negotiation party could attach to, in a sense that they say, okay, this is the tariff we have to lower in order to get it mechanically lower from the US side. Number two, Trump wants the tariffs to, generate revenues, and he wants to rebalance the global economy, bring manufacturing back to the US, which suggests these tariffs have to stay in place for longer. And number three, I think, he's made an experience in 2018-19 when he, during the first trade war, obviously not as aggressive, not as wide-ranging, not as high in terms of the tariff levels as today, but still similar in a sense that he brought the economy to its knees and the market to its knees on the equity side. The Fed pivoted. This was all at the end of 2018, and this was the precursor, or the kind of condition for the market to bounce back in 2019 and the economy to bounce back while rates kept on falling in 2019. So back then it didn't really hurt him to be quite aggressive. I think the pain threshold is quite high for him actually to roll back anything of what he's announced this week.
So then where is that pain threshold? How far does the S&P fall? Is it the US that is going to hurt the most here?
Well, I think he wants to bring in the Fed at the end of the day. He wants the S&P to fall to an extent. Basically, the Fed obviously is not the S&P by itself is not part of the Fed's reaction function. But he wants obviously the market to roll over to some extent, economy to weaken to some extent, such that the Fed comes in and provides some cushion. And I think then he may start turning around to some extent also on the political side, because you can see that a kind of ground is building.
Well, where's the strike price on that Fed put then? Where's the line? Where does the Fed get dragged into this?
I think there's no specific strike price at the end of the day. It also depends on how high yield spreads go, risk aversion in general in the market. I mean, high yield spreads in 2018 were about 40-50 basis points higher to where they are today. Wouldn't say that this is necessarily the strike price. Obviously, the mechanics are a bit different on the fiscal, on the inflation side this time around. So the Fed is a bit more, let's say, restrained in that regard. But, typically a sell-off would be something like 20% or so, at which everyone starts thinking about, okay, we're probably moving into some sort of recessionary territory. Must be added, I think, and that's important on the macro data side. We've already seen quite some softness. So we've had a non-manufacturing ISM yesterday, very weak number, much weaker than expected, particularly on the employment side. We obviously get the non-farm payrolls today. Let's see where this is going. But these, I think, are the measures which could eventually lead the Fed to become more dovish. It's probably less the market, more the macro data.
OK, so what do you expect to hear from Powell later on today? Is it too early to make that decision? Clearly it is. We haven't seen that kind of a market drop. As you say, though, the data are starting to turn. We need to see more evidence within the hard numbers. Do we have to wait and figure out what happens with the payrolls before we understand exactly what is going to be going on? Walk me through your sense of what the Powell strategy is going to be from here.
Yeah, I mean, I don't think that Powell will immediately provide, kind of what Trump and the market would want to hear. But I think what we have to focus on is how much he, emphasizes the transitory element of the tariff. So if he's very clear and adamant saying, OK, this is just transitory, the inflation doesn't really matter, I think that's an indication, which we could take as a signal that the Fed, kind of would be more willing to pivot, become more dovish going forward if the economy weakens and look less at the inflation data.
OK, so before we get to Powell, though, let's take it back to Europe, Wolf. We're looking at the Stoxx 600 down for a third day here. If this was close to being a worst-case scenario for markets and it hadn't been priced into equity markets, how much further is there for European equities to fall at this point?
I mean, the European market has kind of, seen a bit of a re-rating over the past few weeks. It's gone up to around 15 times 12-month forward earnings. It looks very cheap still against the US, must be said. I think the let's say, de-rating potential in the US is much larger. But on the European side, you could easily see, a reversal, let's say, of what we've had since the beginning of the year. So maybe a 5 to 6% drop from current levels. Obviously, it all depends at the end of the day on what we get from the political side and what we get from the macro data side. But I think the European economy is kind of, moving back into a more difficult position after everything has brightened up a little bit over the past few weeks because, the kind of, let's say, the excess supply, in particular coming out of Asia, will probably shift to Europe. And Europe needs to protect itself against that. So competition globally will rise outside the US. If the US is being removed, let's say, as a source of demand globally, there'll be a lot more competition elsewhere. And Europe definitely stands to suffer in this regard.
What do I do, therefore? I'm a PM. I'm being whipsawed on a daily basis. I'm struggling to get a sense of direction. I'm struggling to understand the paradigm that I'm now operating in because of the level of uncertainty that Trump is providing. Yeah. What do I do? Do I go to the sidelines? Do I stay invested? The strategy over the last few years has been stay invested. Does that still apply in this kind of a world?
On a total return level, I wouldn't think so. But I would say on a relative basis, there's still a lot of opportunities. I mean, defensive versus cyclical. It's been one of our key positions over the past few months, just looking not only at the kind of underlying macro data and development in the cycle, but also in general how cyclicals have outperformed into, let's say, mid-December. This was quite excessive. And I think this trade is unwinding, meaning defensives have still room to outperform. And that's what we've seen over the past few days. I mean, look at utilities. This is a sector, for example, which is a bond proxy on the one hand and is purely domestic. No matter if you look at the US utility sector, the European utility sector, it's not affected by tariffs at all, and as such benefits in that kind of environment. So we stay very defensive on the sector allocation side. And if we go to regions, our key preference within regions is the UK market, because this market reflects a lot of or has a lot of the attributes which are quite positive right now, in a sense, being very defensive, value heavy, and not having a major trade component. It's very internationally exposed, but there's very little trade of the constituents which are trading in the UK market.
Look at the UK. Hasn't been the story for a while. Maybe that's about to change. Wolf, thank you very much indeed. Really appreciate you joining us this Friday. Wolf von Rotberg, equity strategist at J. Safra Saracen. Thank you very much. Let's take a look at the core six, what's happening here in Europe, get some understanding of what the picture looks like. As you can see, a mixed picture certainly emerging this morning. Luxury is actually catching a bid. Ferrari's catching a bid as well. It's up by, as you can see, roughly circa 0.5%. Similar story over with Nestle. People are looking at the utilities. People are looking at the food and beverage stocks. Maybe less on the beverage, more on the food. Nestle is up by 0.5% as well. But pharma is taking a huge hit this morning. As you can see, Novo Nordisk down by 2.5%. Let's talk more about what we're watching out there. Joe Easton provides us with those details.
So another sector that can't catch a break, Guy, is the banking stocks. Really hit hard once again at the open of trading, particularly in the Spanish lenders, seeing BBVA coming down 3%, Santander as well. Santander actually coming out and reiterating some of their targets amid the uncertainty. But this generally just a move that seems to be driven by worries around growth, given the tariffs and therefore the effect on banks, the effect on interest rates. Seeing Deutsche Bank coming down almost 4% as well. And even NatWest in the UK, the domestic-focused UK lenders not spared from the downturn despite the lower tariffs in the UK. So broad losses across banking and then also broad losses across pharmaceuticals today on news that Trump did comment on potentially tariffs coming in. He reckons there could be, though, as usual, pretty unclear on the actual details on that. But we are seeing losses across the big ones exposed to the US. AstraZeneca, Roche, Novartis, Novo Nordisk dropping. Remember, they avoided the sell-off yesterday on hopes that tariffs would not be seen, because that was kind of suggested in the announcement. But we are seeing a reversal of that at the moment. So weakness in pharma, weakness in banks, the two main sectors in focus today. Then in terms of Gerresheimer, KKR walking away from that potential bid from the maker of syringes supplied to Novo Nordisk for their weight loss drugs like CagriSema, the new one that's coming out, and that hitting the stock pretty hard, down 8% for Gerresheimer in Germany at the moment, losing interest from KKR according to reports. And then BP, this potentially just driven more by the actual declines once again in the oil prices, but also we've got news of the chairman standing down amid pressure from Elliott, who's been pushing the company to continue refocusing on the traditional oil business, moving away from renewables. That chairman stepping down, potentially adding to the weight on BP this morning, down almost 2%, a big weight on the FTSE 100 for that one. And then over in catering, Sodexo, we had a profit warning from them a few weeks ago, and today they've given another update. Cash flow weaker once again at the catering company over in France, really continuing the big slump that we've seen for that stock. It's not getting any better, according to their report. And then finally, we'll finish on some green. We haven't had enough green. Actually, the only green stock that we've got to finish on a positive note, it is Rheinmetall continuing that massive rally. This seems to be a consequence of generally the US becoming more detached from Europe, and therefore the Europeans having to defend for themselves, rearm, the rearmament trade continuing in Europe, and therefore Rheinmetall, one of the best performers once again. Pretty much you can guarantee that stock's always up at the moment. Rheinmetall up 2.7% in Germany this morning.
All right, Joe Easton from our equities team, we thank you with those stocks on the move at the open. You mentioned BP, you mentioned the broader headache happening in the energy space, the third worst performing sector this morning. That's down 2.2%. And we're going to dive into the oil story next. Under pressure very much on Trump tariff fears and a surprise output hike from OPEC+. We're going to look at the outlook for you next. This is Bloomberg.
How's it going? Let's find out. 18 minutes into the session. As you can see, European equities are definitely on the back foot. Once again, we are near session lows. So we're just bouncing off again session lows. We did see an initial gap lower. We popped a little bit, but we're chopping around at this point. There's the move you can see. So basically, we went kind of left to right yesterday, down, down, down. We then see a little bit of a gap lower first thing this morning. We're kind of chopping sideways now, but what we're not seeing is a bounce after that initial gap. So the gap's not being filled at this point, and we are awaiting clearly Powell and Payrolls maybe to provide us with some guidance a little bit later on, Lizzy.
When it comes to the oil story, though, you've seen Brent also on the slide, down 1.9% this morning. $68 a barrel is where we trade at the moment. WTI is at $65 a barrel. And there are a number of factors here. We've got the tariff story, but we've also got the latest moves out of OPEC+. A real shift, a dramatic policy reversal here. Let's get some analysis now with Bloomberg energy reporter Stephen Stapczynski. Stephen, you've got to explain the politics for me here. This surprise OPEC+ move. What's going on?
Yeah, I mean, this is a surprise, right? We went into the meeting yesterday expecting Saudi Arabia and other OPEC Plus leaders to say, hey, let's look at compliance, rubber stamp this, and move on with the May production hike. But instead, they decided to hike output threefold for May, which is not something that they've been doing. They've been defending higher prices for the last few years. So suddenly, on the day where prices were already down because of the tariffs from the Trump administration, you see OPEC Plus also boosting output. The situation, as reported from my colleagues in Europe on this story exclusively from Bloomberg, is that it's a sweating designed to kind of pressure those who aren't complying with the output targets from OPEC Plus, specifically Kazakhstan and Iraq, and maybe even Russia. This is something that Saudi Arabia doesn't want. They want the countries to not be producing above what they're supposed to, and in order to punish them in a way, they're getting prices to fall even more. So taking advantage of this bearish element from Trump, this president per se, to kind of put more pressure on them. It's surprising, it's a gamble, but that seems to be precisely what they're doing, and it's adding to this kind of tumbling of prices and bearish environment in the oil market.
Stephen, what's on the radar this morning for European trading desks? What are they watching? Is it what is happening with OPEC and the fallout from there? Is it what is happening with the trade story and whether or not Europe responds? Is it what Powell says later, what payrolls are going to indicate about the labour market in the United States? Give us a sense of what is going to guide the market today.
I mean, I think it's certainly all of the above. Any way that you can get any indication from Powell or what you're going to do with interest rates or how the Fed is going to act, clearly that's going to be very important. But I think the main thing, at least when we're talking to traders, the main thing is the retaliation to the United States. What's the European Union going to do, and what's China going to do? I think China, I'm sitting in Asia. China's a really big story here because they are the world's biggest crude importer. And these tariffs against China were huge, right? They were on top of previous measures and levies against the country. So you're already facing potentially a slowdown in exports to the United States from China. That's going to potentially hit their economy, potentially hit their demand for oil. You're also going to see what are they going to do to retaliate, because they will. They're going to hit back. They said they will. They haven't put forward any details, but they're going to most likely also put additional tariffs against the United States or other measures. How will that affect the global economy? And if it does take a hit to the global economy, that's going to reduce oil demand in the long run. Also, clearly, is Trump going to do it, right? That's another thing. One thing that traders, not just in the oil market, in the gas market here as well, there is some hesitation as to whether or not Trump will actually follow through with pushing forward these measures over the weekend and the next week with the tougher tariffs. So there's a lot of uncertainty, but I think right now the main focus is the trade war.
OK, and I just want to focus on BP as well, Stephen, because the stock is down more than 2%, but we know that that's not just because of this broader oil story, it's also because the chair is leaving. What does it say about this pivot away from net zero when it comes to the company's strategy?
I mean, the chair was one of the biggest proponents of that net zero strategy. There's been a clawing back on that over the last several months and years. Elliott recently invested in the company to kind of push for a strategy shift. I mean, taking a step back, this is part of a wider story about how big oil is doubling down on oil, right? There was a shift pre-COVID into the COVID years that maybe oil demand had peaked. It did not. It continued rising. And maybe we need to make a wider shift into renewables. The thing about renewables, solar, wind, hydrogen, more so the former, wind and solar, it doesn't make as much money as upstream oil and gas. The margins are thinner. And while it does provide an opportunity to get into a nascent market that's clearly growing, the investors, stockholders, those folks want larger returns, and there is this shift over to back to fossil fuels.
OK. Bloomberg Energy reporter Stephen Stapczynski, we thank you as we watch that BP stock price, Guy.
Absolutely. We're going to turn our attention now to what is happening with, I guess, in some ways, a related subject. Airline officials have held out hope that transatlantic flights could escape the worst of the effects of President Trump's campaign to rewrite the rules of global trade. But there is certainly a concern that the economic fallout from all of this will lower demand on one of the most lucrative routes, if not the most lucrative route out there for major carriers in the world, the North Atlantic route between the United States and Europe. Bloomberg's Benedict Campbell, who leads our aviation coverage, joins us now. Benny, good morning. European airlines, IAG in particular, have been huge beneficiaries of this North Atlantic route for quite some time. Trump is trying to rewrite the story. I'm wondering how that is going to manifest itself in terms of demand on those routes. What are we expecting? What are the carriers expecting?
So if you take a step back about a week ago, these carriers, they all met in Brussels, the head of IAG, which owns British Airways, the head of Lufthansa, the head of Air France. And the tone there was still fairly upbeat. The Lufthansa CEO said that the relationship is healthy, that the demand is there. The Air France CEO was a little bit more measured, saying we're keeping a very close eye on what's happening in the North Atlantic. And then on Monday, Virgin Airlines came out, Virgin Atlantic, and said that they are noticing some weakness, particularly from the US to the UK. So not the other way, but people traveling from the US to the UK. And that really spooked the market, because that was the first time that a company, an airline, had publicly come out and said, look, there's something here that we don't like. And Air France fell, British Airways fell, and you've seen the stocks really not recover from that. And there's a lot of concern out there about this route. You mentioned it, it's the most lucrative route out there. Just to put it in perspective, British Airways makes $1 billion in revenue on that route alone every year, so they have to be really protective. But it's leisure and it's corporate customers that are really affected here. You know, if you look at what's happened to stocks in the last 24 hours, companies will be thinking twice about corporate spending, about corporate travel, and that will probably have an effect on that particular route.
Benedict, thank you very much indeed. Benedict Campbell, who leads our global aviation coverage. Thank you. Coming up, we're going to be talking about how Europe does respond. France's president pushing for a stronger European response to Trump tariffs as new levies cast a long shadow over a key NATO meeting in Brussels. We'll be live there next. This is Bloomberg.
Welcome back to the opening trade. We are 30 minutes into today's session, and the Stoxx 600 is down 0.9%, another down day for European equities. The DAX in Frankfurt 0.8%. The FTSE not actually managing to escape the pain this morning, despite the tariffs being a little lighter on London. But we can think a bit more deeply, Guy, about what the European retaliation response is going to be.
Yeah, I think London is suffering this morning because of what is happening in the oil trade. You are seeing the majors down under quite a lot of pressure, and so you've got BP down, you've got Shell down. That's a big weighting within the FTSE 100, plus also the farmers, Astra. When basically you've got the oil trade and the pharma trade down, London is going to be maybe under a little bit of pressure. So let's talk about what comes next. And one of the big things that everybody's watching for is how does Europe ultimately respond to what we have just learned out of the White House. The French President Emmanuel Macron, quick to respond to President Trump's tariffs, urging basically European businesses now Europe is the largest trading bloc with the United States, to basically pull back on spending. Tariffs are a major talking point as well at the NATO foreign ministers meeting, which is taking place in Brussels. Bloomberg's Ollie Krug is there for us. France and Germany, Ollie, pushing for a reasonably strong response to the latest tariffs. What clues can we discern from what foreign ministers are saying at this NATO meeting?
Yeah, Guy, I mean, really the sort of conversation around trade is going to have to coalesce at the EU level early next week when the trade ministers begin to have their formal conversations about how to respond to Donald Trump. We heard from Ursula von der Leyen already, but as you mentioned, Guy, we're already starting to get a little bit stronger language coming from really the two biggest players in Europe, from France and from Germany. You have Emmanuel Macron, who's really urging French companies and European companies to basically dial back investment, to completely pause investment into the United States. And that follows what we heard from the German economy minister Robert Habeck, speaking very sort of frankly, very sort of powerfully yesterday, saying basically that this imposition of tariffs by Donald Trump over the global economy is equivalent to Russia's invasion of Ukraine in terms of its impact. What is interesting is how are these sort of different players going to get on the same page and sort of coordinate their response? The United States has obviously the advantage of having a very strong president with a lot of power consolidated behind him and being able to move unilaterally, while in Europe there needs to be a lot of discussion. However, the Europeans may find allies in other places. I just spoke to the foreign minister of Canada, Mélanie Joly. Have a listen to what she had to say about the response to Trump.
I think the only strategy the U.S. is putting on the table right now is they want to have strong hands every time they're negotiating with countries, and they want to do bilateral deals. What is clear is the president wants to do a global reset on trade, and it's his vision to do so. I've had conversations with Secretary Rubio about that. And the question is how much political capital is President Trump willing to spend on a recession?
Donald Trump, it's clear from the sort of cabinet of Donald Trump that they are betting on the fact that the United States is the only game in town that everybody will come to heel. The question is, could a sort of consolidated group, you know, a sort of G7 -1, could they come together in order to put up some resistance? We'll have to see if that materializes in the next few days and weeks.
Well, Ollie, she mentioned it there, Mélanie Joly, the arrival of Marco Rubio, the US Secretary of State, trying to reassure European allies of the US's commitment to NATO. Do you think that they believe her when the US is slapping them with tariffs, when it's saying you're pathetic freeloaders and you need to spend more on defence?
Well, listen, I think that that'll come down to the individuals here, right? I think that for many people here in NATO, they heard from Marco Rubio exactly what they wanted to hear from the U.S. administration, saying that basically there is a full support of NATO, that Donald Trump is fully committed to NATO, but they want a NATO that can defend itself on its own two legs, saying, again, reiterating that 5% target of GDP that came from Marco Rubio. He even said for the first time that the United States itself is going to hit 5% of its own GDP spend on defense. But you pose the right question here, Lizzy, and that's a question I put to the Canadian foreign minister, and she said, really, at the end of the day, I mean, just as Guy was alluding to with Scott Bessent giving a sort of narrative on tariffs and maybe Marco Rubio giving a narrative on foreign policy, at the end of the day, this comes down to one person, and that one person is Donald Trump. And what we got from Marco Rubio is also a suggestion about how the European states could potentially hit that 5% goal, because, of course, where the money is going to come from is the fundamental question here. And he's saying, listen, you guys have built these lovely welfare states. Maybe it's time to give some of that up and plow it into defense.
OK, Bloomberg's Oliver Crook on the ground for us in Brussels at day 2 of that NATO summit. We thank you. Now, Bloomberg has learned that US officials have told their British counterparts they're going to discuss the UK's proposal to reduce those tariffs we were talking about below that minimum 10% level. But they warn that Donald Trump may decide that number is his permanent baseline for all countries. Let's get analysis now from a true expert, Ali Renison, Associate Director at SEC Newgate and also former policy advisor to the UK Business Secretary. Ali, really good to have you with us around the table. I want to start with the UK, given your former role. We heard from Donald Trump yesterday on Air Force One saying he thinks the UK is pretty happy with this 10% tariff. We got off lightly in the eyes of Donald Trump. What's the point of negotiating then between London and Washington if we can't get below that 10% rate, or can we?
I think that it's obviously, we're in the situation of being the best of a bad bunch right now. It's obviously not just the 10% baseline. We've got 25% tariffs on our auto exports, and the U.S. is the second largest market for UK sort of automotive exports. So, I mean, ultimately, this is about kind of reflecting the importance of trying to get some kind of constructive trade relationship with the United States. 10% is not where we want to be. The average kind of trade tariff that we were facing before was about 3.5% on kind of our exports to the U.S. So it's not the kind of baseline that we want to stay with.
But so what should the UK be offering in these negotiations? What do we have to offer? I mean, is it on digital services? Is it on agriculture? Because we heard from Howard Lutnick in an interview with Surveillance yesterday saying he's baffled that the Europeans don't want to have American beef. Are we going to have to accept American beef and chlorinated chicken if we want reprieves from this tariff policy?
Well, we know that the barriers issues that US companies face are the same as they always have been, because we've actually kept a lot of some of those EU rules. The 10% tariffs on automotives, we still have that in place. We still have a lot of the EU's rules in place on, as you say, kind of food safety standards. I think, it's going to be sort of come down to issues of looking at how our digital services are regulated, not just taxed, because we know that actually Ofcom, the regulator, has been taking enforcement action recently against US companies who have platforms sort of UK users that aren't complying with it. And that's not something that the White House is thrilled about, because they already have this perception that there is this sort of free speech sort of censorship online in the UK. I think on agriculture, I mean, I just came back from a trip to Washington for Second Gate, and it was interesting talking to members of Congress where they said, we can't have a deal that doesn't touch agriculture, but we know that we're not going to get probably the most sticky, sensitive issues tackled. So we'd like to see some kind of maybe reduction in tariffs for agriculture, for our farmers, basically.
OK, let's pick up on that. Is Congress going to stop Trump when it comes to tariffs?
It's trying to increasingly insert itself. I think the issue for a lot of Republican members of Congress is they don't want to do this too sort of, they prefer doing it behind closed doors for now. But we have started to see votes come to the floor of the Senate in terms of challenging the president's authority on a cross-party basis, with a handful of Republican senators who are very skeptical about tariffs, challenging the president's authority for some of these tariffs. And then the latest one is that there's going to be a vote on requiring Congress to authorize the tariffs within 60 days or they fall away.
How, as another country, do I think about how I negotiate with the Trump administration? Congress is potentially going to make changes. Do I wait for those changes? Do I sit back and hopefully see some sort of give back when it comes to what has been announced thus far? Or do I need to negotiate? And if I'm negotiating, am I a prisoner in this process? And are there other prisoners out there as well? And I'm wondering how Europe thinks about this in relation to how the UK is thinking about this, how Canada is thinking about this, and whether or not actually I'm also negotiating with everybody else in terms of the way that I'm negotiating with Donald Trump. Give me a framework for thinking about this, and is the prisoner's dilemma actually the right way of looking at it?
Well, I think the UK is particularly in an invidious position relative to other countries, because it is trying to negotiate with lots of other countries, mainly the EU. It's trying to reset its relationship. It's trying to get a deal on agriculture. And it's also very conscious that as a trade-exposed economy, the UK actually can't afford to get dragged into a trade war, even if we don't get hit with high as tariffs as, let's say, the EU or other countries. It was interesting looking at the recent global trade outlook from Allianz Trade was found that basically that the UK could have $8.5 billion in exports wiped off if it really gets sort of mired into a US, China, EU kind of trade war. So I think that the Prime Minister is trying to have this argument that he's not having to choose between the US and the EU, but it means that he's taking a very heads-down approach to a lot of that engagement. So he thinks he can balance it.
Do I need to think about what others are doing in terms of the way I negotiate? If somebody else gets a better deal, does that affect how I negotiate?
It means you have to get in there quickly.
Precisely. So the prisoner's dilemma does apply here.
It does. I mean, there's a reason that he did not have, as he had with Canada and Mexico tariffs, a delay of a month to kind of allow for this negotiations, because he knows that if he makes them come into force right away, people are going to be clamoring to get them kind of removed, exempted ASAP. And it was interesting to watch one of the president's son, Eric Trump, was talking about the fact that if you want to get in there, you get in there first. You don't want to be the last country to negotiate with the U.S. But the UK is in a decent position because it's one of the few countries that the White House has talked about actually doing a structured deal with.
Yeah, but you want to be the first to negotiate, but doesn't that work the other way around? You want to be the first to retaliate as well. If you're the UK and you're watching the EU threatening, potentially using the anti-coercion instrument, going nuclear with the ACI, does that not mean that you need to be tougher when you're handling Donald Trump if you're Keir Starmer?
I don't think the UK economically, because of how exposed it is to trade, is in a position to really do that level of retaliation, quite frankly. And interestingly, outside of Canada, the only US trading partner we've seen talking about large-scale retaliation, we've already seen them say that they're going to do it in response to steel and aluminium tariffs. Those are actually due to come into force in the next 10 days. No one else is really talking about large-scale retaliation yet. And I think the UK is probably wise not to go there immediately while it tries to have a negotiated solution.
And if you're the Trade Secretary, Jonathan Reynolds, is it actually possible to have a coherent trade strategy at this point? Or if you're any Trade Secretary, or is everything necessarily reactive to Donald Trump?
It certainly makes it harder to have a proactive trade strategy that is all-encompassing, looks at, I'm not sure how detailed we're going to get when it comes to what is our actually negotiating positions with the EU and the US, because it's a series of moving parts right now. I think the trade strategy is going to be very broad brush and talking about the kind of sectors that it wants to increase the trade with the rest of the world.
We were hearing from the Canadian Foreign Secretary a little bit earlier on the show, talking about how Canada has a very strong relationship with the UK and the EU, sees itself as being European. Is there any chance of coordination in terms of the response?
Well, that's actually another question that UK has to think about, because we saw that when Mark Carney, the sort of current Prime Minister of Canada, went to Brussels and got an invitation to participate in an EU-wide defence production scheme, President Trump was talking about, if EU and Canada kind of work together to do economic harm to the United States, we're going to double the tariffs. And I think that there are some choices here now for the UK, less so in terms of retaliation, but what is about a coordinated response, even when it comes to WTO? Are you going to take sort of a case against the US, the WTO? I don't think Donald Trump would look kindly on that.
Is the WTO going to survive this, do you think?
I think that, the WTO has increasingly become a forum for dispute resolution rather than trade liberalisation, so it's probably going to become very, very busy.
What do you think? Where do we end up? I don't know. There's so many different questions here to be answered. The final question, I guess, is does this get resolved quickly? This is the question that the market is trying to understand this morning. So many factors at play here, so many different permutations and possibilities.
Are we in for 4 years?
Are we in for 4 years of this? Is this going to carry on and on and on? Or is this something that ultimately gets resolved quickly and the market can move past it?
I think it depends on what the true objective, and only he really knows, that of Donald Trump's tariffs are. If it's about having tariffs to sort of generate revenue for U.S. Treasury coffers, then I don't think we're going to see much back and forth. However, the fact that he's talking about kind of deal-making and his instincts there, I think we are in for 4 years of a lot of back and forth on this.
Ali, great to see you. Thanks for stopping by to see us. Really interesting. Ali Redison, Associate Director of SEC Newgate and former policy advisor to the UK Business and Trade Secretary. Quick look at what is happening within the market right now. So banks are under pressure. You are seeing this across the continent. You've got Commerzbank, Deutsche, UniCredit, Santander. There's a range of banks that are down hard this morning. Some of them have been halted. We've seen trading halts in Italy already this morning. So what you're seeing this morning is banking stocks under significant pressure. Oil and gas stocks are also coming down pretty hard in the wake of what we saw yesterday with OPEC. It is another down day, and we've got a long way to go, Lizzy. We're waiting for Powell. We're waiting for payrolls a little bit later on, a sense of where the US economy is right now. I don't know, does Powell give the market a bone a little bit earlier on? Is there any sense of there being a Fed put? We will wait and watch with interest.
Yeah, better be a pretty big bone if Powell's going to throw us something to save this market before the weekend, Guy. But coming up, with less than 24 hours to go, there's not much time left on the clock for a TikTok deal. We'll have the latest on that. Could that spare China? The tariff story here, could it get Beijing a bit of relief? That's next. This is Bloomberg.
Friday the 4th, good morning. You're watching the opening trade. We are 48 minutes into the equity market session. It's pretty choppy out there, to be honest. Euro-dollar's coming under a little bit of pressure. What's happening in the bond market? The banks are getting bashed. Oil stocks are certainly under a little bit of pressure. We're waiting for Powell. We're waiting for payrolls. Friday's not done by any stretch of the imagination. Certainly no sitting back today. We've also got, obviously, to watch this deadline for TikTok, Lizzy, as well.
Yeah, well, Donald Trump says that he's open to tariff cuts in return for phenomenal offers. Could China make him one? He's reiterated that he'd offer tariff relief for China if Beijing approves the sale of the US operations of TikTok. The deadline tomorrow for divestment. But if they can't meet that deadline, they get shut down in the US, and that is less than 24 hours away. So President Trump saying that a deal is close, but significant hurdles remain. Bloomberg's Charlie Wells joins us now around the table to walk us through the next steps. Charlie, what do we know about where we're at?
TikTok. I've got to make that joke here. Basically, there have been a lot of suitors. Amazon kind of came out of the woodwork recently and said that they were interested. It's not clear that that's being taken very seriously, but Bloomberg has learned that the proposal that is being taken quite seriously by the Trump administration involves a consortium with Oracle, Blackstone, and Andreessen Horowitz. Now, what we know about this potential deal, the terms there would be that new investors would hold about 50% of that spun-out U.S. TikTok. Old investors would have about 30%, and then ByteDance would retain just under about 20%. Now, one potentially kind of sticky element here is the fact that in the terms of this deal, ByteDance would retain control of that algorithm that's at the center of TikTok that's so important. It would be licensed out to that U.S. spinoff. But this is a real kind of difficult point because it's the algorithm that really kind of powers TikTok, but it's also at the heart of that ban or divest law that was passed last year, which is the reason why we have this deadline in the first place.
Parents everywhere are about to have a quiet weekend. Is TikTok about to go dark?
I mean, that's really, there's precedent for that. Yes, yeah. That could make a quiet weekend. There's precedent for that. That happened back in January. Trump has signaled that he would potentially, give another extension here. But he's under a lot of pressure, right? Because not only do investors need to agree to this deal, ByteDance and China also need to do this. And Trump said just yesterday that he would maybe use tariffs to try to get that deal forward. But China doesn't want that. ByteDance doesn't want that. They don't want to be under this pressure or set a precedent that the U.S. can kind of cherry pick. But also, it was a bipartisan group of legislators who passed this law last year. Bipartisan support for this. So at some point, he's going to have to enforce that ban or sell law.
OK. Bloomberg's Charlie Wells with an update. We thank you. As Guy looks forward to a quiet weekend, potentially, without TikTok in his house.
There's no such thing as a quiet weekend in my house. We'll come on to the weekend in just a minute. There's plenty of sport to watch out for. Charlie, stick with us. Let's talk a little bit about what is on Val's agenda, because basically all she cares about really is Powell and payrolls and exciting things like that. She's not worried about the sport. Am I wrong?
Look, I just don't know how anyone can think about the weekend when we have payrolls and Powell speaking both ahead of us. The first one being non-farm payrolls hitting the tapes at 1:30 UK time. Look, I think many out there think the risk is a pretty terrible market reaction on a bad print, but
don't we want a bad print? We want a bad print, don't we?
In some way, maybe the bad print opens the door for front-loading of rate cuts from the Federal Reserve. So that's a bit perverse if you think of it that way. But look, the argument out there is it's too soon for this weakness to show up in the labor market, and we're not going to get that today. But then we go straight into Powell. And if you look at how the Fed pricing has changed since we last heard from him, which was only, a week or so ago, we're now pricing in 4 rate cuts from the Federal Reserve this year. So 100 basis points of cuts. Previously, we were pricing around 2 cuts from the Federal Reserve last time he spoke. Even take it all the way back to January, there's even less. So does he say anything about this recent pessimism that's been baked into global markets since Trump's announcement yesterday? Or does he continue to say that the U.S. economy is on a strong foot and the U.S. economy is resilient? Does he continue to paint a good picture? We'll really be parsing any hint of pessimism from Powell, because that could perhaps the equity market could not like that on a Friday afternoon headed into a weekend.
No. The weekend is coming, I promise. Transitory?
Well, if he uses the word transitory, again, how bold at this moment, but it would say a lot. Val, look, the dollar's actually up. A bit of strength after yesterday. Euro dollar down 0.3%, 110 on euro dollar.
It's still north of 110.
OK. But
no, look, but we're beginning to unwind some of the dollar softening move yesterday. And if you take a look at what's happening here in Europe, we're seeing credit spreads widen again, especially in junk bonds. That's leading to losses across European banks. So I think this second round effects is, wait a second, maybe I'm not so positive on the European growth outlook here. And I think that the market is continually going to be reevaluating this narrative of first round effects versus second round effects. And today it seems like the second round effects is people are pretty worried about Europe right now.
But do they start? Is this also starting? Are we starting to position for the possibility that Europe, come Monday, Tuesday, Wednesday next week, starts to respond? And that's the next risk. Okay, beyond Powell and beyond payrolls, but that's the next risk that the beginning of the next week potentially holds, and that's maybe where Europe comes back with a strong response. Trump comes back with an even stronger response, and that's really quite growth negative.
Yeah, who's going to be the first one to stick their neck out there and really retaliate strongly, right? Is it going to be Europe? Because one could say that he even went to announce these reciprocal tariffs because he had Europe in mind, and maybe that's what he's baiting for, is a European response. But that could be one thing that could shift aggressively the growth outlook of Europe. That's already been knocked a bit from these tariff announcements. Well, I shouldn't say knocked a bit, knocked substantially from the reciprocal tariff announcements yesterday. But it looks like the going forward, I mean, even take a look at what the German bond market is doing today. It's another 10 basis point rally, right? So you have to start to question this notion yesterday that we were really excited about the fact that the U.S. could enter a recession and the rest of the world be fine, right? I think we're going to go into, the market is going to be trading these narrative shifts back and forth.
Which market is leading the narrative this morning? Is it
bank stocks in Europe?
You think it's the bank? So, but the bank stocks are responding to the credit story, aren't they? So which
it's
kind of
economic slowdown, right? I mean,
so
those two things are combined.
Okay, so we're watching the bond market, watching credit spreads, we're watching and that feeds into the banks.
Yep.
And that then ultimately feeds into the euro. The euro kind of feels in some ways it's at the end of the line on that one.
Yeah. And you have to acknowledge that this dynamic is also happening in the U.S., right? We had credit spreads in the U.S. widen. We had the bank index, the KBW bank index, have its worst day since the regional banking crisis yesterday. So these dynamics are happening on both sides of the Atlantic. I think the play out for the dollar is just which one outcome is going to be worse. Maybe the retaliation is the next kicker.
We are going to get to the weekend. Post Powell, post payrolls, the whisper numbers is, I think, 120. I think 140 is the survey. So it's going to be interesting to see what happens there. There's a lot of sport this weekend. I feel like I'm quite excited. There's a Grand Prix.
I don't see any rugby on that list.
There's a Grand Prix. Well, I watch other sports. Next weekend is the golf. Okay, so that's kind of the really exciting one to look out for. I know you're excited too. I can tell. Basketball. It's a big weekend. I think we can all get behind that one. Final four. So that's going to be exciting. But there's a lot of sports on there. But I know Snowden beckons. There's all kinds of other exciting things happening out there. Charlie, what you got a big weekend lined up?
Okay, my sport is I'm going to go on a walk at the beach. That's sporty, right?
The weather's fantastic.
We need it after this week.
I think we all need a bit of a sort of detox over this weekend. We'll get through Powell, we'll get through payrolls. We'll think about next week. A bit of sports.
I'm just going to have a very long nap after this week, right?
I think, yeah.
We could do
until Monday morning, basically. That's how long the nap is going to last. Then we're all going to wake up on Monday morning and is it still the nightmare? I don't know. We'll wait and see. Anyway, the weekend edition is also available out there. If you don't want to have a long nap, you can find it on the web. It's a collection of interviews, ideas, stories that explore the fascinating places culture and life meet. You can also probably kind of read a few things about what's been happening in the markets this week. Anyway, that is there and available for you. The Pulse is coming up next. What a week it was. I suspect next week is going to be quite the week as well. We all deserve a weekend. The Pulse is next. This is Bloomberg.